right? They don't. Nobody can know who they belong to except you. So you're the owner of those wallets. Now, when you're making transactions on those wallet to wallet, decentralized wallets, do you have to report those as well or no? Because to my understanding, it was all these central where you onboard and offboard, and anything that you do within those exchanges, the centralized exchanges, that's where the taxes come in, right?
So one one important thing to remember is even if a decentralized exchange is not falling under these KYC regulations and reporting requirements that the government's issuing, even if the government isn't directly receiving your transaction data from an exchange, you are still under the obligation as a taxpayer to report and pay the tax that you owe based on your capital gain loss activity. And so, whether the government directly knows the information or not doesn't take away your obligation as a taxpayer to still pay the tax that you owe. If you were to, from a decentralized wallet or exchange, um, incur a taxable event, that you're still obligated to pay the tax you owe as a taxpayer. And so, if the government in 2 years' time, figured out another way to sort of come across the data and realize that you actually underpaid, or potentially were trying to avoid paying the tax that you owe, then they could impose penalties, interest, other fines on you, even if it's a couple of years into the future. So, always safe to remember that your obligation to pay is not predicated on the government having your access to your information. Let's hope that helps clear that up.
Yeah, the reason I ask is just because, when you're in these decentralized wallets or exchanges, there's a lot of hacks and phishing attacks that happen. And I was one of the victims, I guess you can say. About 5 months ago, somebody apparently went in my wallet and just drained my wallet. Now, that wallet that I had my funds in, I wasn't KYC'd in it, right? Like, so would I have to report that as a loss? And obviously, I have all the transaction hash and everything. But how can I prove to the government that I was hacked and I did not send it to another wallet that I generated, another new wallet or so? Like, do you understand what I'm asking?
Well, I guess the one point to note is that just sending funds to another wallet doesn't trigger a taxable event, so you wouldn't necessarily have to prove that that's not taxable to the government. On the point though of funds being stolen, unfortunately, as an individual investor, there's not a lot from a tax perspective that you can do at this point to write off a loss. Unless you have a business and you're operating within the context of a business entity and you incur theft or loss, you can actually write that off on your business. But as an individual, there's not a lot that can be done from a tax perspective. I would definitely still encourage you to speak with attorneys and try to pursue some recovery options potentially. And I hope that, just given the nature of the crypto space, I hope that some of the tax regulation eventually reflects, an opportunity for folks to, potentially recognize losses due to theft as individuals. But yeah, unfortunately, there's not a whole lot from a tax perspective that can be done there.
Yeah, I guess that's why I asked, because you said that wallet to wallet transfer is not a taxable event, right? So, um, I mean,
Correct.
that's what happened with me. But the thing is, it wasn't my wallet that I went to; it was the hacker's wallet. So, yeah, I mean, I hope they figure this out. But yeah,
For anyone that's just joining, we're asking a few common questions first to Kate, who is our expert here on the panel. We see your request. We will be bringing people up here shortly. We just want to kind of get some of the common questions out of the way first. Another one that I have, Kate, is if I'm swapping, say I'm swapping one asset for another. So many of us buy into Binance tokens. In order to do that, we have to swap from Binance to the token that we're trying to trade for, that we're swapping for. Would swapping one asset to another constitute a taxable event under current law?
Yes. So anytime you exchange one type of token for another, that is going to constitute a taxable event. And the only tax that you would be liable for is capital gains. And so, for example, if your initial swap to that Binance token, if it's, say, Ethereum that you've held for a few months and you definitely have appreciated in value, at that point, when you switch to the Binance token, you would owe capital gains tax on that value appreciation in the ETH. But then if you were to switch again fairly quickly, say, within 24 hours from that Binance token to another token, and there wasn't much change in value, you would be triggering another taxable event, but the capital gain would be fairly minimal, given that the value fluctuation in a few hours time probably isn't a whole lot. But yes, anytime you do switch from one token to another, that is triggering a capital gains taxable event.
A lot of people have the misconception that you don't pay taxes, you don't pay realized gains or report losses for that matter until you convert back over to fiat. That is incorrect, right?
Right, and I'm so glad we can clear the air on this one and really hammer this point home. Yes, converting to fiat is a taxable event that is also going to trigger capital gains, but even when you're just exchanging from token to token and you never convert to fiat, you do still owe capital gains tax. And I know it feels strange to not actually have the cash on hand, right? That you still owe tax on. But unfortunately, regardless of whether you convert to fiat, just converting between tokens is triggering capital gains. And so if you end up incurring a capital gains liability of, say, $1,000, you will still owe capital gains tax on that, and you may have to then later convert some crypto to fiat in order to pay the tax bill that you owe. And so it's always wise, if you haven't made any conversions to fiat yet, to just kind of earmark some of your crypto that, if you do need to make a conversion later to pay your tax bill, that that you can set aside to do that. And if you do have capital gains liability, it's also really wise to sort of earmark some tokens that you think may have decreased in value that could help you recognize some capital losses to be able to then offset your capital gains. And so then by virtue of converting those to fiat, you'll recognize a loss and then also have the cash on hand to be able to pay your tax bill as well. So sort of double benefit there.
Perfect. The second question that I have, and then we'll open up the floor for questions, is a lot of us here, including myself, we are invested in a token named Safemoon. They recently went through a consolidation, which is 1 to 1,000. What is the guidance upon that consolidation for as far as taxation goes? Would that constitute, if we switch over from the version 1 token to the version 2 token, would that constitute a taxable event on the consolidation?
Yeah, so maybe you could walk me through, when you say 1 to 1,000, do you mean like essentially like a split basically, or is it like, maybe you could just clarify for me what you mean by that?
Yeah, so if we're seeing it from a securities view, from a stock investment, it would be a reverse split, essentially. I know that under current IRS law, there's no guidance for cryptocurrencies for things of that nature for a reverse split. I know that the guidance with the IRS, when a reverse split occurs, does not trigger a taxable event. Would we then use that same guidance and apply that towards cryptocurrency? If that clarifies it.
Yes, absolutely. So, yep, I would absolutely agree with that, a reverse split or a split would not trigger a new taxable event. So if that is the case with the Safemoon token, then safe to say that you're not going to be triggering any type of capital gains if you've held that token for a period of time and the value's gone up, and then the creators exercise a reverse split. That's not going to trigger a bunch of capital gains for all the holders. So hopefully that will bring everyone a sigh of relief who's in that position. Might have been worrying about that.
Yeah, it's been a kind of an ongoing question in the community, so I just wanted to get some clarity on that. Nomics, I don't know if you have any further questions. If you do not, we'll go ahead and go with the first speaker, which is Safemoon Millionaire. So Nomics, if you don't have anything to ask, let us know, and then we'll toss it over to Safemoon Millionaire.
No, we'll go ahead with Safemoon Millionaire.
Hey, everybody. How are you today? Katie, thank you for coming up and doing this. Appreciate it. I have a couple of quick questions for you here. You were just talking about the Safemoon. So the way that we look at Safemoon with the version 1 to version 2 contract, it's technically a sell from a smart contract that we do incur a 10% fee on. And then when we move over to the version 2 contract, there's also a 10% fee because as you go in and out of Safemoon, they do charge you a 10% fee for that buy and that sell. So technically through their smart contract, that's considered a buy and sell. Would we still refer back to a reverse stock split as far as the tax code rules go, because under their contract, it's considered a buy and sell with those fees incurred?
Let me clarify something. The Safemoon contract has a 10% fee for buying, selling, and transferring. So what he's referring to, the 10% tax, is off of that smart contract.
Yeah, so that does pose an interesting point, right? If from Safemoon's perspective, like they're effectively exercising a sell and a buy, I would still make the argument, though, that from a holder's perspective, because the split is sort of out of your control as a holder, right? It's not a decision that you're making to convert from one token to another. It kind of, if I'm understanding correctly, it sounds like it happens automatically, or is this something that you can elect into as a token holder?
Well, you can elect into it, but technically it's kind of a forced election because you're going to be left behind on a contract that's no longer going to have security aspects. So if you don't migrate over, you could be looking at a total loss.
Yeah, so from that to that end, I would make the argument for any of my clients, if this situation arose, that would not trigger a capital gains tax event, even if there are transaction fees, for example, that you're incurring by virtue of this version 2 sort of conversion happening. While those fees will just be added to your cost basis in the new token, I still would make the argument that it's not going to trigger a taxable event, because it's not if it's true that it's sort of more of like a forced election, right? It's just kind of like a stock split happening. It's just from the perspective of a holder, not an actual sell and rebuy from my perspective. And again, that's just my opinion, and every CPA is entitled to their own interpretation and opinion about transactions like this that don't have any formal regulation at this point in time. And so if you speak with another CPA and they want to make the argument that, yeah, actually we should recognize a sell and a rebuy and trigger capital gains tax, they're not wrong either. But I think that obviously the more advantageous tax perspective would be to take it as not triggering a taxable event. And until we get regulation to the contrary, that's the argument that I'd be inclined to make.
Okay, so on the other side of that coin, I have an account that I use that I've invested $130,000 into the Safemoon, and that's over the period of since early March, and it's been at a loss at this particular point in time when I went over. So there's, I think it was sitting at around $75,000, that one account anyway. So I could make the excuse or the argument to argue that at that point, I could use that as a taxable event to incur a loss to help me out with possible income throughout the year at the same side of that, correct?
Yeah, so I think the beauty of the sort of lack of regulation is that as long as you can make a reasonable argument that you are, applying the tax legislation as best, as you see fit in a circumstance like that, then you could make that argument as a taxpayer that, hey, yeah, this actually, the smart contract, this triggers a sell and a rebuy. And if you wanted to get a little bit of, more, solid justification behind that argument, you could just consult with a CPA and sort of get their sign off on that and on that treatment. And then if the IRS were to come knocking, if you were to be randomly selected for an audit or something, then at least you would have just the ability to fall back on, a professional and say, yeah, this is our justification. We talked through the logic of, the circumstance, and we viewed this as a, triggering a taxable event, and we recognize some losses here. That's your only obligation as a taxpayer, to make a good faith effort and be able to justify any of the claims that you're making with respect to your tax activity. And if you can get a tax professional to sort of sign off on that and be in your corner, if the IRS comes knocking, even better, more power to you.
Yeah, that's always the advice I give, is always cover yourself as best you can. You're better to overpay and get a check back than underpay and owe a check. So appreciate that. The last question I have, hopefully, I get this question probably 10 times a week from a lot of people because I hold spaces here on Twitter. People are confused as to whether you need to pay long-term gains tax based off of the first time that you purchased into a coin, or off of the last time. Point in fact, if you make 100 transactions throughout the year, and the first original time that you purchased was, say, April, a lot of people got into the Safemoon project in April, and then your last purchase was December, does your long-term capital gains or short-term capital gains start with your original purchase or with the last purchase? And if so, is it a tiered program where you could pull out funds at a later date at a gain to equal or under the equal amount of what the amount of tokens were that you purchased on that first initial buy 12 months and 1 day later, in order to only incur short-term gains tax versus long?
Yeah, super, super important point again, and another really common question that we've been talking about in a lot of spaces as well. And so maybe I'll clarify first, with respect to cost basis in any of your investments, you are allowed to elect whatever cost basis calculation method is going to be most advantageous to you. So average cost basis, FIFO, first in, first out, HIFO, highest in, first out. The only catch is, whatever calculation election method you choose, you have to apply that method consistently over all of your investments that fall under the capital gains bucket for the entire tax year, so for 2021. So with respect to crypto and NFTs and stocks, you've got to choose one method and say, if you were to choose HIFO, highest in, first out, then when you say you were to purchase into a project, in December, and that happened to be when the value of the token was highest, and then you were to then say, okay, I'm going to use some of this token to make a purchase, or I'm going to exchange it for something else, that would trigger a capital gains tax implication. Then by virtue of using HIFO in that scenario, you will trigger short-term capital gains and have the highest value tokens be the first that are sort of applied to that transaction, or used, however you want to sort of word it to be, so that people can understand. To the contrary, if you were to use FIFO, first in, first out, then you rewind all the way back to the first purchase on record of that token, and those would be the quote-unquote tokens that you're using to then make that exchange or make that purchase. So again, just need to be consistent with the method you choose across all asset classes that fall into capital gains. And then I would make my recommendation has always been to if possible, run your capital gains calculations using all methods, and then figure out which gives you the most advantageous tax position, rather than trying to think through, a couple of individual circumstances and think, okay, does it make more sense to think of it this way or not? And again, if this is sort of late in the game for you for 2021, at least for 2022, everyone can have this in mind and take this approach where, if you run your capital gains calculations ideally on a monthly basis, and you have an understanding of what types of transactions trigger taxable activity, then on a monthly basis, you'll have a general sense of, okay, what's my capital gains liability from an average cost basis approach, from a FIFO and HIFO approach. And then that can help guide your decision making as you move through the year about timing of buying and selling, etc. So really glad we could touch on these 3 points. This is a bit more advanced, kind of into the weeds. It's not like super often that we go into the detail like this, but it is really it is the level of understanding that's required in order to start to make some smarter decisions going forward around timing, about buying and selling. So really glad that you brought this up. And if I've confused anyone further by saying this, please just tell me to rewind and we can definitely talk through that, any piece of that again.
Yeah, and the reason that I'm asking these more advanced questions is because I work in the financial industry and I have to deal with tax lawyers or tax accountants, CPAs all the time. And pardon my expression, but they are really a pain in the butt. And a lot of them don't know what's going on with crypto. And I actually have to kind of guide them on that, which is ironic. But I will say this, you are definitely one of the most well-versed people that I've ever spoken to in the CPA world about cryptocurrency, and I really, really value your opinion. Anybody that's here should definitely be writing stuff down because you're one of the most clear, concise, cut person that I've ever spoken to in this. So I may actually contact you to hire you. I really appreciate what you're doing. Thank you very much for answering my questions.
Oh, that's so kind of you. I can't tell you how much I appreciate the compliment. You know, it's I'm an introverted accountant, and you know, for me to get up and do these spaces has, you know, taken a lot for me, but I just know how important it is to get this information out for people. And so just to know that it's helping and you know, that you find value in it really does mean a lot. So I appreciate you saying that.
Kate, you're hired. Safemoon Millionaire, thank you for that. Kate, I do have a question, and this has been asked by multiple people in the community, and it goes back to these cryptocurrencies that have tokenomics on them. So essentially, what happens is you pay a tax for that crypto that you're purchasing, and say, for example, Safemoon has a 10% tax to purchase, to buy. But when you hold the tokens, you receive reflections for every transactions that occurs on for that crypto. So you're being rewarded in the token, and obviously the price depends on the project as well. The question is, do you have to pay taxes for receiving those reflections off of that project? And these reflections come in for every transaction that happens, you're receiving them. So literally like every second.
Yes. So the recommendation that I would make regarding reflections is to view it uh, like in the real world, view it like interest income. And it would then effectively be taxed at ordinary income rates. Um, and the tricky part about this, as you mentioned, is that in a lot of these circumstances, it's not just once a day that you're receiving, you know, the sum of reward tokens, right? It's like, could be hundreds of times a day, right? And the valuation of these tokens fluctuates hour to hour. And so you could really run into a pickle where you're trying to determine the USD value equivalent of these reward tokens so that you can, you know, account for it properly for tax planning, etc. And again, going back to sort of making a good faith effort here, if you were to have an entire day, as long as you were able to determine what the average USD equivalent value of that token was for that day, then I would make the argument that you could apply that valuation to any of the reward tokens you received throughout that day. But you should be aware and recording the USD equivalent value day to day, and then how many reward tokens you've received, you know, each day, and then that will be reported as taxable income, ordinary income tax rates. Think of it like interest income that you used to earn on your savings account when savings account used to give us some form of interest income. And you can think of it kind of like staking as well. Any sort of rewards for staking is going to also be, in my opinion, viewed as interest income and will all be taxable. I think that's the key takeaway, is that anytime you're receiving something of value, the IRS wants their piece, and it's probably going to be taxable in some way, shape, or form.
So include if someone decides to gift you a certain amount of tokens or USDT or whatever crypto they send you, you have to pay taxes on that as well, right? as a receiver?
Did you say a gift?
Yeah, if someone gifts you crypto, do
Yeah,
you
so
have to pay taxes on that?
so there is a gift tax exemption threshold, and at the moment it's $15,000 US for recipients of gifts. That so then anything $15,000 or under that you receive as a gift is not taxable to you. But the key thing to remember is that's the total of all the gifts you've received for that year. So if someone gifts you an NFT worth $1,000, and then someone else gives gifts to crypto tokens worth $10,000, and then someone else gifts to you a car that's worth $5,000. Oops, we just jumped $1,000 over the threshold. So then $1,000 of the total gifts would then be taxable to you at your ordinary income tax rate. But up to $15,000, you can receive gifts of any kind, and that's not taxable to you.
Okay, perfect. The next question is, can people, if they do not receive more than $15,000 in reflection, can they claim those reflections as gift? And keep in mind that these reflection tokens are mostly on decentralized exchanges, so there will be no reporting from centralized exchanges. But some centralized exchanges, such as Bitmart, does implement tokenomics for Safemoon. So obviously they will be reporting all the reflections that they give out to their holders. But these decentralized ones, you have to claim them yourself. Can people claim those reflections as a gift?
In my opinion, it would be a tough argument to make to classify those as gifts. I wouldn't advise trying to do that. And again, even though a lot of these exchanges are decentralized and may not fall under these reporting requirements under the infrastructure bill or otherwise, it still does not free you of your obligation to pay tax owed, whether the information is being reported to the government or not. And so you still owe the tax. And I do think you'd be hard pressed to find an accountant that would be willing to make the argument that that's a gift. That being said, though, because there's no regulation, if you do find an accountant that's willing to back you up on that argument, more power to you. You can, until there's regulation to the contrary, right? If you can take a professional's opinion and run with it, go for it. It wouldn't be my opinion, though, unfortunately.
I appreciate that. Now I'm just trying to look out for the community, and obviously the best legal way they could do it. Try to save some money. Why not, right? But we'll go with the next speaker, K Fulton, and then Brian, and then Sam. Go ahead.
Okay, Fulton, go ahead. You're up.
Okay, so I want to kind of understand this a little bit more. So you're saying a taxable event, right? So if I own a stock I want to talk about stock first, and then I'll get into crypto. So if I own a stock first, right, and the value goes up, and I sell that stock, and then I buy into another stock, that's a taxable event, or is it?
Yes. So if you hold a stock and it goes up in value and then you sell that stock, you will owe capital gains tax on the value increase of the stock. You also bring up a really interesting point though about buying another stock then immediately. If you buy another stock, there's no problem with the proceeds. If you were to rebuy back into the same stock, though, you'll be under what's called the wash sale rules penalty, whereby you can't buy or you can't sell and rebuy into the same stock within a 30-day window. Otherwise, you'll be breaching the wash sale rules and owe a penalty on that. Cryptocurrency, though, and NFTs are not subject to the wash sale rules yet. And so this is a scenario that many people are using to try to recognize some capital losses. You could own some crypto tokens, say you own some ETH, and ETH has a massive crash like we've seen in recent weeks. you could sell your entire position in ETH at a 10% loss. And then immediately tomorrow, when it bounces back, say ETH bounces back up tomorrow or the next day, you could rebuy back your entire position. Or you could not even, you don't even need to wait to rebuy back your position. Actually, you could sell your entire position at the loss, rebuy back in an hour later at the same price, and you've now recognized a taxable loss that you can use to offset your capital gains, and your position effectively didn't really change all that much. And the reason that that's illegal in the stock market is for obvious reasons. So that you can't manipulate your taxes by just buying and selling when and timing the market dips. But crypto is not subject to the wash sale rules yet, so that's something that you can still take advantage of and try to use to your advantage for tax planning and tax loss harvesting. It's a little bit like more advanced. If you don't understand that, I wouldn't recommend, trying to do it unless you really do understand what you're doing and you know the tax implications. But that may have been an overcomplicated answer, but I think circling back to your initial question about stocks, yes, it is going to trigger a taxable event if you sell a stock that you've held and it's appreciated in value, and then you can rebuy that same stock or another stock. But if you rebuy the same stock, you have to wait 30 days. If you rebuy another stock, you can do that immediately with no penalty.
Right. So, I mean, I guess that's my question. So, if I bought a stock at a certain point, right, and then I sold it, and then I bought into another stock, right, and that value depreciated, and then I took that and invested into crypto. Like, I mean, is that appreciated value or depreciated value? I guess is what I'm looking at. I'm trying to understand.
Yeah, if you were to sell a stock, say, and then use those proceeds to buy crypto, um, the only taxable event you'd be triggering is capital gains potentially on the value increase or decrease in the stock during the time that you owned it. So, without looking at a specific circumstance, I couldn't tell you if that'll trigger a capital gain or loss. But essentially, from the period of time that you purchase the stock or crypto or any asset under capital gains purview, when you eventually sell it, whatever the value change up or down, that will trigger capital gains in either capital gains or loss. And then you can use those proceeds to reinvest in, another asset class like crypto, and that's fine. And then your cost basis in the crypto would just be your purchase price. And then when you later exchange that crypto for another type of asset is when you would incur another taxable event, capital gains on that new crypto that you purchased.
But wouldn't that capital gains from not the first sale, but if I rebought into something, I mean, is that still capital gain or is that? I'm just trying to understand. I'm sorry.
No, that's fine. And please keep asking clarifying questions because someone else might be thinking the same thing. Um, so let's walk through a scenario. If you purchase a stock or crypto today for $100, and then next week the value has appreciated to $110, and you decide that you want to sell it because actually you think, well, this $10 increase was great, but I heard that crypto has $50 increases, so let me just sell this now and then I'll buy some crypto. When you sell, you'll have $10 of taxable capital gains amount. And then if you use all $110 to then buy crypto, you still owe tax on that $10 increase, even though you never cashed out to fiat and now your proceeds are sitting in crypto, which is a new asset. You still are on the hook for tax on that $10 gain. Does that help clarify a little bit?
Yes, it does. But my question, yeah, it does very much. But I guess,
Okay, Fulton, if I may interrupt, we have a lot of requests, so if
yeah,
you
my
don't
bad.
mind, no, that's
No
okay.
worries.
You can get one more question in for clarification, and then we have to move on. Okay, sorry about that.
Yeah,
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 or
my
feel free
bad, dude. So
to DM me and
not
we
at
can
all.
chat offline.
So okay, so if I did that, all right, let me step offline. I don't want to take people's time. You're good.
Yeah, yeah, sure. We
Thanks,
can
guys.
definitely we'll follow up offline. Perfect.
Yep. Thank you.
Okay, Brian, you're up next. Thank you, K. Fulton.
Yeah, just real quick. Thanks for being here. It's really good information. I was curious again about the Safemoon thing because and I'm sure you're aware the 2019 tax code came out and kind of said, hard forks and especially with airdrops were taxable, at the time of airdrop. And my concern with Safemoon was how they actually did their swap and whether it was a taxable event because it was a new ledger, which seems to be the specifics in the IRS tax code as if it is a new ledger, right? So I was curious if your thoughts on that, or whether that going to a new ledger makes all the difference in the world, or if it's kind of, something to where a CPA can kind of manage that, like you said. Just like your thoughts on that.
Yeah, absolutely. And I think you're absolutely right. Moving like the new ledger factor, right, will eventually be the make or break determining factor once we do get solid regulation on crypto and NFTs, with respect to nuanced, transactions like this. But yeah, until then, because there is no hard regulation, yes or no, one way or the other, it is just up to CPAs to interpret the tax code as it stands and apply, that same logic to these, circumstances in crypto and NFTs. So if your CPA is willing to stand by that decision and argument with you, there's a really good chance you're probably not going to get audited. But they are cracking down on crypto transactions a bit more, and so maybe that increases your chances slightly, but I'd make the argument that your chances are still probably like 1 in 1,000. But yeah, as long as you and your CPA are in agreement, you've talked through the logic, and you can defend the position, then the worst case scenario is that an IRS auditor would come back to you and say, oh, actually, I think, going forward, you should maybe do it this way or whatever. But they can't actually tell you that you have to change the decision that you made one way or the other because there is no regulation to the contrary. And so as long as you have an accountant on your side helping you with the decision making, then you're going to be fine.
Interesting.
I
Okay,
just
thank
want to
you.
clarify something, Brian, because you said that it's a new ledger. It is
Yeah,
not a
that's
new
what I was
ledger.
curious.
Yeah, no, the SafeMoon V2 is on a proxy contract, but it still operates on the Binance blockchain. So it's the same ledger. It's just a different contract, and the migration is mandatory, but there's a time frame for it. So this shouldn't be, in my personal opinion, this shouldn't be a taxable event. I know some people said that there's taxes when you're migrating from the old version to the new version, but the consolidation is 1,000 to 1 because the old contract had 1 quadrillion tokens, and now the new contract has 1 trillion tokens. And if you do get charged that fee, there's a form you have to fill up, and then you receive your those taxes back. So there is no taxes for migration for that contract. So I just wanted to clarify that so Kate knows
Okay,
exactly what she.
so when they made the it's just a new smart contract. Then it wasn't a hard fork to a new ledger.
Exactly, yeah. So when SafeMoon comes out with their own blockchain, then it's a new ledger. But
Yeah,
as
yeah.
of now,
Okay,
it's still on the Binance blockchain.
okay, cool.
And to clarify, guys, there is no current law, right? There is nothing in place that provides us any kind of clarity for cryptocurrencies in that event. I think what Kate, and please correct me if I'm wrong, Kate, what we're using here is the guidance that the IRS provides in the event of a reverse split would be that it would not constitute a taxable event. So I think that's the logic that's being used towards the guidance that's being provided.
That's correct. Yep. And, as soon as we get new guidance and new regulations, I'll be the first one to be tweeting, Mayday, Mayday. So just keep an eye out. I don't foresee that happening probably within the next 6 months, surely. I think for the 2021 tax year, the amount of regulation that we have is probably going to stand. That being said, in March, they could release something that is retroactively, applicable to the 2021 tax year. Let's hope not. But I think we're probably safe to say that as it stands now, we're probably 6 months away from any more solid regulation at best. So yeah, hope that helps.
Brian, do you have anything else?
No, that was it.
Appreciate it, Brian. Okay, we got to keep moving, guys. We do have a lot of requests. Please be patient. If you are requesting, we will pull you up as other speakers are put back down to listening. I believe Morgan is next. Go ahead, Morgan.
My question is in regards to the unrealized gains. So as long as we aren't doing any sort of, day trading, let's say we got in, and this is all hypothetical, but let's say we get in a cryptocurrency for $1,000 and we've held, and that goes up, and we don't sell, we aren't taxable for anything except that which we've invested in initially until we decide to pull out. Is that correct?
So you're correct. We can definitely celebrate that unrealized gains are not taxed. So if you buy, a token, it goes up in value, you don't exchange it for fiat, you don't exchange it for another type of currency, you don't use it for a purchase, you're not triggering any taxable event just by holding crypto or an NFT as it increases in value. So, yep, you're good there.
Okay, thank you so much. That's all I had for tonight.
Thank you for coming up, Morgan. Nomics, who is next? I lost track.
Hey Jock is next, followed by Don.
Hey, thanks for pulling me up. I had just two questions. Once, just to follow up on Morgan's question, wouldn't a sale of an NFT technically be considered an unrealized gain if you don't convert it to fiat? Or no, it's still a taxable event?
Hey, Josh, good to see you again.
Yeah, I was here last time.
Yeah, I remember you. So yeah, really good question, because it's such a tough concept, I think, to conceptualize that just by virtue of transacting in crypto and NFTs, there is no USD that's changing hands. So it's hard to imagine that you could owe tax on activity that's not actually putting any cash in your pocket, right? But yes, if you buy an NFT, and then you later resell it, you are triggering a taxable event. If that NFT has gone up in value, you'll be taxed on the gain. If the NFT has gone down in value, that will be a capital loss that you can use to offset other capital gains in crypto or other NFT transactions, or stock activity. And just with respect to NFTs, really quickly, I'll note that when you're calculating your taxable gain or loss with respect to an NFT resale, just be mindful that your cost basis in that NFT is going to be your purchase price plus any gas or transaction fees that you incurred when you purchased the NFT. So by including that, that will actually reduce the amount of gain that you'll be taxed on when you then later resell. So don't forget to include gas fees and transaction fees that you incurred on the purchase, because that'll reduce your actual taxable gain amount later.
Okay, wow, that's good to know. Thank you for mentioning that. And my final question is, so the NFT sale is a taxable event, and then if you were to convert the proceeds of whatever crypto, either Solana or Ethereum, to fiat, that will be a taxable event as well, correct?
Yeah, and this is where the IRS is really sticking it to us. So you're effectively taxed twice, right? So you
Right.
incur a capital gains tax when you sell the NFT, but then you take your proceeds, say your proceeds are $1,000, and then you hold the proceeds for a month, and say the proceeds are ETH or SOL, and it's gone up in value in the month that you've held that, and then you decide to convert to fiat, you've got capital gains again. So it is really a question of timing, and just being smart about when you're cashing out to fiat. If you need to, just be mindful that you will be triggering a taxable event again. And in a situation like that, it's effectively double taxation on the same funds, which is really unfortunate.
Okay, great. Thanks so much for the information, Kate. It's always a pleasure. Have a wonderful day. Happy holidays.
Thank you, Hey Jock, for coming up, guys. Again, I would encourage you to please follow Kate. She is very active on Twitter. She is active in multiple Twitter spaces. I've pinned to the top a few informational sheets that she has provided. I will also be tweeting them after the space, where it answers many questions in a very simple form as to what is a taxable event. If you can, like I said, please go ahead and follow her. You can always DM her as well with any questions that remain unanswered. Cryptonomics, who was next?
Don Bailey. Go ahead.
Don.
Crypto Beta, what's going on, guys? Kate, thank you so much for doing this. So I think I have a pretty good understanding of like where I'm sitting in terms of taxes, but I just have a question to reconcile what I see as a loophole in my head, and I was wondering if I can get your clarification on it. So, when we refer to taxable events, the taxable event would, or my understanding of it is that it relates specifically in a change in the underlying asset. Is that correct?
I think I understand what you're asking. So yeah, the capital gains um, event would be changing
Anytime
value
an underlying asset changes.
only if you. So the only ways to trigger capital gains tax are to exchange for another asset, effectively sell,
Hmm.
or use that crypto for a purchase.
Okay, so my question is because the Binance, because the token is on the Binance chain, right? Could I effectively make an argument to the IRS that the underlying asset is actually Binance and not the SafeMoon token that's traded on Binance because the price of Binance directly affects the token price?
I imagine eventually that might be the argument that is made. So like that's essentially what like a stock is, right? You're actually, it's not a token that you own. You actually have
Correct.
ownership in the company, right? And so that's why we've got SEC registration and regulation. Um, and so I'll be curious to see what direction this goes. I do believe though that the nature of crypto, being able to essentially transact and use it as a currency gives it additional utility other than just value in essentially ownership like a stock is, right? So
Sure.
because of that additional utility, I don't know if we ever will reach the same level of regulation as a stock whereby the underlying value and underlying asset is essentially the company, or in this case Binance. um, I don't think we will get there. We might. It'd be hard to say, but I think at the moment now, making that argument that the underlying asset is actually Binance is probably not going to fly. I think it's still, crypto is viewed as property, and the IRS has been very clear about making that distinction, at least for better or for worse. And so that is regulation that we do have to stand by, is that in the eyes of the IRS, crypto is classified as property. And so by virtue of exchanging, buying, selling property, you're triggering capital gains.
Okay, thank you so much.
Thank you, Don. We appreciate you coming up.
We have Jimmy up next. He's been waiting for a while. Thanks for your patience, Jimmy. Go ahead, brother.
Oh, hey. I think I just have a really quick question because I've heard it from multiple different CPAs and was pretty back and forth with it. But the main question is, being a day trader with both stocks and crypto, is your because it's like in a sense, is it 1099? I don't know what kind of form you get at the end of the year because this is my first year day trading and I've been doing quite well. And so, with that being said, are like your phone, your internet, and other utilities that are helping create this capital short-term gains, are they write-offs for you?
Thanks, Jimmy. Yeah, another great point. So if you are engaging in day trading and you believe that you do qualify for trader status, either in crypto or stocks, then you're essentially viewed as a self-employed business owner by the IRS. So uh, you can access any of the normal, ordinary business write-offs that a business owner would be able to do, like home office, phone, etc. So yes, if you do believe you qualify for trader status, all of those write-offs will be open to you. Similarly, if you're engaged in mining, crypto mining, I'm sort of making the recommendation and argument that if you're engaging in mining, that should be viewed as a business as well, due to the regularity, etc. So that would also allow you to take the ordinary necessary, write-offs, like you said, in order to uh, be generating that income, right? You've got equipment costs, you've got your ordinary business expenses. So yes, I would just make sure that you do believe that you qualify, because there's a couple criteria you need to meet, and if you do feel like you fall under that criteria, then absolutely you're good to go. And I do apologize, everybody. I have another call I do have to jump to in a minute. I can probably take one more question, and I'm more than happy to come back to do this again. I think this is really adding a lot of value. And I know that we've got a lot more questions to answer too. So I'd be more than happy to come back maybe later this week or this weekend, and we can jump on again just to make sure that before the end of the year we get as much of this information out there for everybody.
Certainly, Kate. We can coordinate that again. Nomics, go ahead and choose the final speaker, please.
I had another really quick question though, if that's okay. So when you move from one brokerage to another and it's the same, like let's just say I move Ethereum from one brokerage, say crypto.com to Coinbase, is that taxable or no? But it's still in Ethereum form. That's my last question.
Nope, not taxable. So moving from different exchanges or wallets, not going to trigger capital gains.
Awesome. Okay, thank you so much, and thank you again for hosting this.
Thank you, Jamie.
Calafia, you want to go up? Brother, go ahead.
Yeah, thanks. I appreciate it.
I got it.
I've been waiting. Okay.
Kate, I was wondering if, as far as like I LLC, I do crypto mining. I'm not buying or purchasing. I'm mining. So how does that work as far as the tax laws regarding that?
Yeah, so if you're mining crypto, again, you'll be viewed in the eyes of the IRS from my perspective as owning a business, self-employed business owner. And so that will be taxed at your ordinary income rate. So the USD equivalent value of the tokens that you're mining, you'll want to get a daily sort of value stamp on those tokens that you're generating through mining. And then the USD equivalent value in total for the year will be taxable to you at your ordinary income tax rate, less any of the eligible business deductions that you're able to incur. So your equipment costs, your internet, all of that stuff will be expenses related to generating that income. So you're not going to be taxed on the total revenue amount that you're generating. It'll be the net amount less your business expenses. But whatever that net profit amount is will be taxable to you at ordinary income rates.
And I would be at ordinary income, but I would be able to utilize the pass through with that, right?
So if you don't have a formal business entity set up, like an LLC,
I do. S corp.
You do. Oh, you have an S corp. Okay, yeah. So if you've got an S corp and you're mining via the S corp, then you'll run corporate tax rates on that income. And then if you take any distributions or if you're put yourself on payroll, etc., then the income would be then taxable to you at that point. But from the S corp's perspective, you'll have the corporate tax rate applied to your net profit on the mining.
Perfect. Thank you.
Okay, guys. Kate, are you able to take one? I know RJ was waiting. I think he was skipped. If you can be brief.
Sure. Yeah. If it's a quick one, happy to take it.
RJ, last one.
All right, thanks. Hey, I appreciate it. Again, I'll get right to it. Yeah, I think we talked about this earlier, how ledgers and hard forks actually, created this property distinction where, where there was a hard fork, and I'm speaking quickly. So if there was a hard fork, it actually created a division, a duplication, so to speak, of a property token in one ledger and then a property token in another ledger. And therefore, the IRS distinguished it as actually property. And that's part of where we ended up in this discussion where property actually was the basis for where we're going. And I was reading through the June 2021 memorandum from the IRS that talked about the 1031 like kind exchanges. I'm also, I'm one of those lawyers that Safemoon Millionaire was talking about that were pains in the asses. And again, this is not an area that I know a lot about, but it's one of those things that I think is just a point of discussion. I wanted to get your idea about this. Where we're talking about these reflectionary tokens, again, two types of reflectionary tokens. One that reflects in its native token, like Safemoon, and some that reflect in a different dividend creation type token, where it's reflecting a non-native token. In each of those circumstances, if we consider them to be property, are we looking at them as if they're non-taxable events when they reflect, but only become taxable with a zero basis at the time of sale? I think you mentioned earlier that they might be considered as interest, but I'm a little concerned with that. And again, I only throw this out there as discussion because if we continue to talk about these as property and like kind exchanges, for example, when we're exchanging Bitcoin for Ethereum, et cetera, those are obvious, 1031 non like kind exchanges. How are we going to reconcile these reflectionary tokens with that 1031 discussion that they gave in June. So I'd just like your thoughts on that. And if you want to take it to another day, you think this is too complicated to deal with in such a short time frame that you have, I'm happy to. Thanks.
No, that's fine. That's fine. I really appreciate you bringing up this topic as well. So, with respect to like-kind exchanges, unfortunately for our purposes, the legislation is pretty clear that like-kind exchanges at this juncture only apply to real property, not intangible property. And so crypto and NFTs would definitely fall into intangible property. And so the like-kind exchange rules won't be applicable unless the IRS comes forward and makes an amendment to the current like-kind legislation.
Yeah, I think that was the June. Yeah, that was definitely the June memorandum that says that they do
Yeah.
not qualify like kind of exchanges. But the distinction was one crypto for another, and I think that was pretty clear. That
Yep.
So I'm not sure how it works with relation to these reflect.
Yeah, and reflection tokens, I mean, my stance on it is that that's sort of new compensation, new value that's being added to you by virtue of you owning this other token, staking it in some way, locking up liquidity in some circumstances. But it's essentially the closest in real life comparable that I can draw it to is like interest income on a on an investment or on a savings account. And so because those tokens do hold value, when you receive them, the IRS is going to view that as taxable income, like compensation to you. And so that's why I'm making the argument that it will be taxed effectively as like interest income, but more importantly, interest income is taxed at your ordinary income tax rate anyway. So just earmark the USD equivalent value total of those reflection tokens received and plan on those being taxed at ordinary income tax rates, unless you can find an accountant that's going to be willing to make an argument to the contrary, or in another circumstance that'd be more advantageous to you. But yeah, that's my position on it, and we might see legislation change that in the coming years. But for now, we're just sort of left to interpretation.
Thanks. My thought was, and again, just for discussion, is that maybe it would be considered as like when stocks split, or they're just by intrinsic value of holding them, they created actually a new um, a new fungible unit of measure like a stock does. So that again is just part of the discussion I think we all need to have, and I think something the IRS is ultimately going to have to deal with. But again, just thought process. And it certainly would have a great impact on whether it's a capital, how it's dealt with capital gain versus ordinary income treatment. So, again, I appreciate your opinion, and I think it's worth further discussion for sure. Appreciate it.
Awesome. Thanks, you guys. And sorry to run, but I do have to jump on another call. So I would love to come back. And please DM me, though, if we didn't get to your question, or we'll probably be able to schedule another session, hopefully in the next couple of days, and we can get to your question then, too.
Thank you, Kate. We'll definitely get in touch, and we can coordinate another space. Appreciate your time. Thank you for being here with us. With that, guys, I will be closing down the space. Cryptonomics, highly appreciate you co-hosting. I hope that the community found this space to be of value, and I hope to be able to bring more spaces like this to you guys. If you have any questions for me, please feel free to send me a DM. I am not a practicing accountant, but that is my background as well. So, and I can definitely consult with Kate, or just DM her directly. And please don't forget to follow Cryptonomics if you're not following him already, and as well follow Kate so that you can DM her your questions as well. Thank you, everybody, for being here. Cryptonomics, anything you'd like to say before we close it?
Yeah, Beto, thanks so much for hosting this space and bringing that CPA in. I think she has enlightened many of us in many different ways, because it is confusing and many speculations around this topic, but it's the best to have a professionalist come here and explain to us and dumb it down for us all, so we actually understand, and hopefully we can share that knowledge that she brought here with us tonight and help others that may have those questions, right? So I apologize we couldn't get through everyone. RJ, I missed your name because I was keeping track of who was coming in line. I did miss your name. I apologize for that. But that was a great question you had there at the end. So I appreciate everyone for coming in. And Beto, thanks again for hosting this.
Okay, thank you, guys.